Alors, bonjour. Hello. Okay, so just before we start, and I promise that I will upload the slides with the audio on, but unfortunately I couldn't do it. I had a technical problem with my laptop. I don't know why I couldn't access to or activate the audio. شو اسمه هذا audio recording stuff, etc. So we will actually go through the chapter together today. We'll just start by making a quick recall of what we discussed last time, and then we will continue. There are some maybe parts that we will just won't cover. It will be covered next year, inshallah, in the advanced accounting class with in the advanced or special topics in accounting, I guess, with Dr. Anas, okay? So inshallah, we will, of course, end up this chapter today. We have some important, as I said, sections to cover. So last time we started talking about current liabilities in particular. So we started talking about what is the current liability. So from different definition of the concept of framework, we defined what is a liability in general, and then what is current. So it's regarding, of course, the maturity period. It's about, of course, the time elapsing between, of course, the obligation and the settlement of that obligation, etc. Okay. So we talked about the different types of current liabilities, like accounts payable, like notes, also current maturities of long-term debts, short-term obligation expected to be refinanced, and then, of course, dividend payable. I guess we start at this level. Do you have any question about all of these items before we move on to the next? Was it clear? So it's important to just make you recall that when we talk about liabilities, so be careful, it's about a present obligation. That's a current obligation, okay? And this obligation actually arises from what? From past events. So there was a transaction in the past that made actually this present obligation will arise, okay? And of course, in the future, the settlement of that obligation will make the company use up some of its assets, okay, like cash, like goods or services, etc. Okay, so this is, of course, the main definition of a liability. As I said, to be classified as current or non-current, that's about, of course, the situation, of course, regarding the operating cycle. If this liability is expected to be settled within the normal operating cycle or within, of course, 12 months after the reporting date, okay? And remember, when we talk about the operating cycle, it should be from the day we just purchased, I don't know, raw materials, all they needed, for example, supplies, etc., till the collection of cash after, of course, of sale of goods and services. Okay, so this is what we call the final cash realization. Okay. So that's, of course, the operating cycle. Why focusing on operating cycle? Because, as I said, operating cycle may be long or lengthier than the just 12 months of the fiscal year that we use it to use, of course, when we prepare financial statements. Okay, so of course we will just rely on whichever is longer here regarding the operating cycle or the 12 months of a fiscal year. Okay. As I said, so we started talking about the typical types of current liabilities. We stopped at the dividends payable, so we'll cover this again. Is there any problem regarding any issues in particular for the current maturities of long-term debt or short-term obligation expected to be refinanced?
No, it's clear.
Okay, good. So let's just move on to the where we stopped last time. As I said, it's about declaration of dividends, and of course when we declare dividend should be recorded as accrued liability. So that's for the refinance, yes, and that's of course when we dividends, yes. So we call this about dividends. So here we have what we call as dividends payable. They are what amount owed by of course that firm to its stockholders, and of course this like money owed by this corporation. They are what? They are the consequence of the authorization of board of directors, meaning of course the declaration of distribution of dividends. So if you just try to, let's say, try to apply the general definition of a liability on this issue of dividends. So we have really actually a present obligation. What kind of present obligation? This obligation that we will have to pay of certain amount to our stockholders. Why this obligation arises? Because we have this past event اللي هو both authorization or declaration of dividend distribution, and of course the settlement of this obligation will make me use maybe some of my cash, of course, to pay off this amount owed. Okay, so that's an example, of course, of current liabilities. Why current liability? Because in general they are paid within 3 months after being declared. Here it's important to mention that we just stress the fact that only declared dividend should be reported as liabilities, okay? Because any undeclared dividend, even though we have this situation of cumulative preference shares, they are not recognized as a liability. I won't like dig further into this concept because we will be talking about equity in general and this issue of preference shares, cumulative dividend, etc. In chapter 15. But what you just keep in mind is that we have undeclared dividends. Once they are undeclared, they should not be an accrued liability. Why? Because there is no, let's say, right to receive this amount from the stockholders, unless, of course, the board of directors authorize and declare them as amount to be paid. Okay. Also, it's important to mention that when we have dividends payable in the form of shares, additional shares, they are not, of course, a liability. Here, we have like conversion of dividends, of course, of money owed in the form of equity. It's not a liability. Okay, so this is what is said here. It should be reported in equity. Okay. Another type here of current liabilities when you have customer advances and deposit. Okay, sometimes, of course, you receive cash from customers and employees, maybe as securities for, let's say, for goods that you deliver or for amount that you will be, for example, a customer that will be purchasing, I don't know, product or service, etc., and will be making installment payment, etc. So you will, for example, get a cash deposit from that customer as a guarantee, for example, regarding your payment of the entire, for example, amount, etc. Okay, so when you have actually this situation, you have receiving cash deposit from customers and employees, and then of course you will have to return this cash deposit. Of course, a determination of the contract, or of course the situation that required this cash deposit to be, of course, collected by the firm. Okay, so of course this situation, we will just collect money, and of course this money that is owed, that will be returned back to customers and employees. For that reason, of course, that should be recorded as a liability. The question will be classified as current or non-current. Well, it will depend actually on the contract, as I said, between, of course, this client and the firm regarding, let's say, the transaction. For example, if this amount will be return it back, for example, after 6 months, after, for example, the full receipt of all the installment required from customers or not. So this will be, of course, qualified as current. If it is, of course, longer, etc., it should be reported as a non-current liabilities. Okay. Another type of current liability is also when you collect money for future services or for future goods delivery, etc. Okay, so here you will receive this amount or this payment before providing goods or performing services. Okay, and you know that only cash that we receive after the performance obligation satisfied, that's the only situation when we should record it as revenues. But in this situation, there is no performance obligation that is satisfied. It will be satisfied in the future. But of course, I collected cash in advance, and this collection should be reported as current liabilities. Okay, it will be, of course, under the unearned revenue account. We have different types and examples of unearned revenues, of course, that will be credited. For example, if you are an airline company that is, of course, selling tickets, of course, for trips, etc., and you will be, of course, collecting money before offering that service to your customers. Okay, you are also magazine publisher, and you have what you are collecting, for example, annual subscriptions or quarter or whatever, and these, of course, subscriptions that are collected in advance. So you receive, for example, an annual subscription from the customers, and you will be sending, for example, monthly magazine volume, etc. So this, of course, money that you collected in advance of sending, of course, this magazine should be reported as an earned revenue, and of course as current liability. Of course, here other examples, like when you rent in a hotel, of course, you will rent, of course, you book a room or a suite or whatever, and then, of course, you are paying, of course, in advance of being there, of course, or using the room for a weekend, etc. Okay, auto dealer, here when you have also you are offering service warranty to your, for example, customers. This is an additional. We'll be talking about warranty in general, or in the next, of course, slides. But here, of course, when you receive a service warranty, that's what we call an earned warranty revenue. That should be also classified as current liabilities. Of course, this unearned revenues will be what? Will be converted, will be, of course, debited, and we will credit the corresponding revenues once what? Once we perform. So here, when you, for example, the passenger will take the flight, so it's no longer an earned. It's already, of course, the performance obligation already satisfied. We already performed the service for that client. Then, of course, we should record it as passenger revenue. Once, of course, here the customer, let's say, receive the magazine here volume, he will, of course, will be recorded as subscription revenues and no longer unearned revenues. Kif for an earned rental revenue. If, for example, this rental revenues, of course, that you started, for example, you provided, I don't know, the home or the place that you will be rented, of course, by the customer. The customer already started using this place, etc. Then, of course, it should be recorded as rental. So it will be converted into revenues once the performance obligation that is satisfied. So once the goods are delivered or services are provided, etc. Okay, so that's for the unearned revenues. So here we have an example of unearned revenues. It's about magazine, Sports Pro magazine, that is selling here 12,000 annual subscriptions on August 1st for €18 each. And you are asked to prepare the Sports Pro August 1st journal entry and December 31 annual adjusting entries. Okay, so here the thing, you are selling annual subscriptions, so you are receiving cash in advance of your services to be, of course, delivering this magazine to your customers. Okay, so on August 1st there is a collection of cash, collection of €18 times, of course, the 12,000 magazine. Okay, but what will be, of course, the other account to be credited? Of course, we'll be crediting the unearned revenue account. Okay, so that's, of course, on August 1st. So December 31 here we should adjust. What should be adjusting? Of course, from August, what should be, of course, normally done is that this Sport Pro magazine will be delivering every month a magazine, okay, to volume, of course, a specific volume to its client, etc. Okay, so here we have from August, we will, of course, count from August 1st until December 31, how much, of course, of months, maybe volumes of this magazine were delivered already. I guess we have, how much? We have 4 or 5. So we have 5, let's say, magazine volumes that were delivered, okay? So for that reason, we should adjust. So for this 5 volume, we should now recognize a revenue that is already realized because we have a performance obligation that is satisfied, okay? So that's why we have to debit the unearned revenue for that amount and of 90,000, of course, and we will just credit subscription revenues for $90,000, okay? So here we have 5 months of subscriptions already used up or consumed because of that, because of the expiration of time here, because we assume that from August 1st until December 31, every, of course, a monthly here period, the client will receive, of course, or use maybe, they can maybe not only receive it, but they can, for example, read them, these volumes online, etc. Okay, they have already the access to these magazines. Other types of current liabilities, they are related to sales and value-added taxes payable. I guess you already had an idea about the value-added taxes and sales in the taxation 1. Am I wrong? So what you are studying in taxation 1?
L'impôt.
IRS, هكا؟
Yes.
Yes.
Okay. So
Tax semester جاي عمده.
Okay, so taxation 2 will be about, of course, value-added taxes, TVA, etc. Okay, so this is just, let's say, snapshot of what we will be discussing, because we will be discussing that in details, and it will be, of course, based on the Tunisian, of course, context. But this is the general, let's say, treatment when you have sales, and of course, you know that most sales will have to pay taxes over that amount, of course, sold. These taxes, of course, there will be most of cases paid by whom? By the customers, okay? So here we're talking about the consumption taxes, and they are what? Either a sale tax or, of course, a value-added tax, okay? So here we have difference between sales taxes and value-added taxes. Sales taxes, of course, they are like كيما احنا في تونس عندنا droit de consommation و value added taxes, they are, of course, the TVA. So the purpose, of course, of both taxes here is to generate revenues for the government. So here, of course, government, they have to fund their budget. So what is the, let's say, the easiest way to do is that we will have to tax customers and, of course, all of these transactions, okay? Of course, sales tax is different actually from the value-added taxes, okay? You will see that in details, but we'll just explain a little bit, of course, the way, of course, of measuring sales taxes, but also the value-added taxes and why it is different, okay? In which extent, okay? So here we have actually the situation when you deal with sales taxes, okay? Here you have example of Hello Supermarket that will sell loaves of breads to customers on a given day for 2,400, assuming a sales tax rate of 10%. Hello Supermarket makes the following entry to record the sale. So here, when you purchase, for example, this loaves of bread, okay, for the, let's say, total amount of 2,400. So here it said that this is the what? Tax comprise, like we use in our jargon, okay? So this 2,400 actually will include what should be, of course, recorded by this supermarket as its sales revenue, and part of it should be recorded as what? As sales taxes payable. That's the liability, that's the amount will be what? Owed to the government. So it will be remitted to tax authorities, okay? Here we will, of course, this situation, of course, it is provided the gross amount, it's not the included, okay? It's not to tax here. It is gross amount of 2,400. Okay, so that's of course the amount of sales. Okay, and we will apply 10% over that sales. That's the 240. So here as a Hello Supermarket, what I will be collecting from the customer, I will be collecting the 2,400 plus the 240 from the customer. Okay, so we'll be collecting the entire 2,640. But the issue here is that this entire 2,640, they are not my total revenues. Okay, my revenues, they are only 2,400, and the remaining, of course, amount, that's a liability. Okay, so my sales revenues, they are only 2,400, and sales tax payable, they are 240. So this is the liability that I am owing this money to be, of course, remitted to tax authorities, let's say maybe every month or every 3 months, that quarter, etc., depending, of course, on tax rules within one country. Okay, that's of course for the sales tax, of course, in a simple here illustration. But let's see the value added taxes issue. So if you just notice here, we have only this Hello Supermarket in this situation, the seller or the business here, the fur. So is acting like just here an intermediary, a third party that will be collecting this amount of taxes from customer and will be remitting the entire amount here collected to the tax authorities. Okay, so the concept is different regarding the value added taxes, because for value added taxes, they are actually paid by some businesses. So as a business, for example, I will be paying value added taxes for my purchases. And then, of course, at the same time, I will be collecting value added taxes when I sell my products. Okay, so here, still as a business, I will be just acting like an intermediary, a third party. But what I will remit the amount to the tax authorities won't be what I entirely collected. Okay, it will be the difference between what I collected from customers and what I paid when I purchase, for example, supplies or raw materials or whatever. Okay, so here, that's the difference. That's the amount that will be remitted to tax authorities. Okay, that's why, of course, value added tax is said to, or to consider to be, an indirect tax, and it is, let's say, only supported or in charge of the ultimate, of course, the ultimate payer of these taxes will be also the last consumer, the last, let's say, entity or person or body, of course, in this business chain. Okay, so here, this is, of course, when we talk about the supply chain. So as I said, as a business, I'm present within the supply chain. I will purchase items, suppliers, materials, all the stuff that I need. Some of them may be subject, of course, to value added taxes, so I should pay the value added taxes. I should pay it, of course, to the other business. At the same time, I will produce, etc., or I will sell what I purchased. So when I will be selling, I will be also collecting value added taxes from, let's say, another business or another or consumer in general. And of course, as I said, at the same time, I have collected value added taxes and also paid value added taxes. So what I should remit is only the difference between what I collected and what I paid. So in general here, the concept is that I will just, let's say, keep the amount that I already paid for. So I will get it again, and of course just remit the difference to the tax authorities. Okay. So here we have the example of this supply chain and this payment and collection of value added taxes. We have Hill Farm Wheat Company that grows wheat and sell it to Sunshine Baking for 1,000. Hill Farm here wheat makes the following entry to record the sale, assuming the value added taxes is 10%. So here, if we assume that we have 1,000 here of sales, and we have value added taxes that is 10%. So as here, Hill Farm Wheats, I will what? I will collect 1,100. So that's, of course, why cash will be debited for that amount. I still should what? Record revenue. So revenues will be only for 1,000, and 100 will be recorded as value added taxes payable. So that's, of course, what I recorded as value added tax payable as a liability here. That should be, of course, in theory, if there is no tax paid, of course, value-added taxes that I paid, that will be, of course, the entire amount will be remitted to tax authorities. The same here, we're talking about the supply chain. So here, the Sunshine Baking, that is making loaves of bread from this wheat and sell it to Hello Supermarket for 2,000. Okay, so here again, you see here. So here we're talking about Hill Farms that is selling, let's say, raw materials to the Sunshine Baking. So Sunshine Baking, it was the one that paid for this value-added taxes. Okay, now Sunshine will be selling loaves of bread, etc., to Hello Supermarket for 2,000. And here, of course, assuming still the 10%. So in this situation, the Sunshine Baking, now it is the seller. So we'll be collecting 2,200. That's 2,000 for the selling price, and plus the 10%, of course, of value-added taxes. It will be, of course, crediting revenues for 2,000 and value-added taxes payable for 200. So in this situation, as Sunshine Baking, I won't actually remit the 200 entire to the tax authorities. No, I will just remit the difference of what I already paid. I paid already 100, and I receive it 200 from the other customer. Okay, so here the amount to be, of course, remitted to tax authorities will be only 100 euro. Okay. Okay, so here if we're talking about selling 2,400 here, so the Hello Supermarket, so again here that's another party in this supply chain. So now the Hello Supermarket that's already paid for the 200, now we will be selling loaves of bread and we will be collecting value-added taxes from the ultimate customer. So here we have 2,400. That's of course the revenue, should be multiplied by 10%. So we got the entire actually cash collected. So the 2,640. And we have, of course, sales revenue for the 2,400 and the value-added taxes, the 2,400 here. So again, the Hello Supermarket won't actually pay the entire 240. They will be only paying the difference of 40 euro. Why? Because here they already paid for 200. Okay, is that clear? Okay.
Yes, ma'am.
Okay, good. Okay. Okay, so that's the income tax payable. So what was already covered, that's the indirect taxes regarding, of course, the taxes that will be, let's say, beared by the customer. Okay, so the ultimate customer that will bear the payment of these taxes. And as you have seen, businesses, they are only what? There are only third parties that will be collecting either and remitting the entire amount if it is sales tax, or just, of course, remitting the difference between what was collected and what was paid, of course, as value-added taxes to the tax authorities. Now we'll be talking about income tax payable. As I said, so we will be just talking in brief regarding this income tax payable, because we have an entire chapter regarding income tax payable here, treatment in the second semester. Okay. So when we talk about income tax payable, here there is, like, let's say, specific treatment for this income tax payable, meaning, of course, how it will be measured and how to be, of course, accounted for and recorded. But what you should keep in mind is that as a firm, businesses, because, you know, accounting rules, accounting standards, they are different from tax standards or tax rules. Okay, so it's common that for businesses they should what? Prepare financial statements that they are what? Aiming to satisfy the needs of investors and creditors and so on. So this is, of course, the objective of financial reporting, as stated by the IFRS, by the IASB concept of framework. But at the same time, tax authorities may have some requirement or may have some, let's say, specific rules for certain accounting situations. So it will be different treatment. Okay, so for that reason, firms, they will find themselves, of course, obliged to prepare two reports. One, of course, for, let's say, financial markets, for investors and creditors, and another report, which is, of course, tax report that will be filed to tax authorities, okay? So here, the income tax actually payable will be always prepared based on this income tax return here report, okay? So, Alish, just giving, of course, this remark because we will see next, of course, in the next semester that the income tax expense, what I incur in most of cases will be different from what I will pay. And why there is a difference? Because there is a difference between the way of measuring the pre-tax financial income, taking into consideration, of course, the IFRS, of course, standards and also the tax rules, okay? So there is a difference, and that's why, of course, income tax payable will be always measured based on this income tax return report. So once we are able to measure this income tax payable amounts, it will be reported, of course, as current liabilities. You know, income taxes, they are what? Liquidated within this, of course, next operating cycle. So there are most of cases paid within 3 months or 6 months, etc. Okay. So this, of course, about this periodic tax payment, and of course, if they are periodic, if they are or should be paid within a short period of time, then of course they should be recorded as current liabilities. So this is what I just talked about now. When we talk about taxable income and accounting income, there are most of cases we have differences, and these differences will make the income tax payable amount that will be different from the income tax expense that we measure regarding IFRS standards. Okay. For the employee-related liability, we will just won't consider this in our intermediate accounting course here for this semester. So slides from 35 to, let's say, yes, so 35 to 41, you should omit them, okay? They are not included into this syllabus, okay? The reason, not because they are not interesting, they are really interesting, but you will be covering these, of course, employee-related issues more, of course, in depth with, as I said, Dr. Anas, hopefully in these special topics in accounting in the senior level, okay? So we'll move on, of course, to let's say what is new for us as majoring in accounting or even minoring in accounting. So what you probably you didn't hear about, it's about provisions, okay? So what do you mean by provisions? And of course, should they be recorded? Should be accounted for, recognized, etc. Okay, so we'll discover all of these issues together, okay? So first of all, what is a provision? So provision, that's a type of liability, but for this situation here, it is a liability that we have uncertainty regarding the timing, meaning maybe the maturity date, for example, of that liability. When I will settle that liability, it is uncertain, I don't know when, or also uncertainties that are related to the amount, how much, okay? So I'm not sure, for example, I don't have the, let's say, the 100%, of course, certitude regarding, of course, the amount that will be paid to settle that liability, okay? So that's important, okay? So provision, keep in mind, it is a liability, but with a specific here feature regarding uncertainty with respect to what? To the timing or to the amount. So I have really, let's say, doubts regarding the timing. I'm not sure when I should settle this, of course, liability, or also I don't know how much, of course, I will be paying, for example, to settle that liability. That's what we call a provision, and that's, of course, the main feature that will make, of course, this type of situation different from the general, the other liabilities, because remember what we defined as liability, a present obligation that will be, of course, settled, and we know that the settlement of this obligation, we have in the other types, for example, for accounts payable, when you purchase on account, on credit, I mean, so you will have, so the amount is really known. You purchase, for example, for 10,000 on account, so you'll have to pay 10,000. Even the timing, of course, you are agreeing, for example, with your supplier that you will pay within 1 month, for example, or within 15 days, etc. Okay, so the timing and the amount, that are well established, known, they are not uncertain. Okay, so here what makes the difference here is that when we can find ourselves in a situation when there are, I have a present obligation that is arising from past events, but the problem is that I don't know when I will settle that obligation, or for how much, of course, this obligation will be settled. Okay, that's why, of course, we call them a provision. Of course, provisions can be also qualified as current or non-current liabilities. Depends, of course, on, let's say, this uncertain timing. Okay, we can, of course, expect that will be, let's say, settled within the operating cycle, within these 12 months, or after that, and of course, depending, of course, on the situations. Okay, what are then the different types of provisions? So commonly we have what? We have, let's say, obligations that are related to litigation. Just imagine you just fired an employee, and the employee filed a lawsuit against you, of course, in court. And then, of course, you are in litigation with your ex-employee. And then, of course, you will be expecting that you will be, for example, paying damages for that employee. Okay, so that's, of course, will happen, or will make an obligation, a present obligation that will rise because of what? Because of this past events. The problem will be, maybe I don't know how much I will settle that obligation, nor maybe when. Okay. Another type of provision is the warranties or product guarantees. Okay, so here we're talking about, when you purchase any product or services, etc., you may be offered warranties. Warranties, actually, if they are offered by the seller, they should be recorded as a liability, and they are the kind of provision. So they are, of course, they should be accrued as provisions. Okay, you can also record a provision when you engage, for example, in business restructuring. So maybe you will be making, I don't know, important, you'll be involved, for example, in making important extension to your business, building new sites, making really this substantial restructuring, etc. And this will just require a lot of money to be invested. Okay, so we can use the provision for that business restructurings. Okay. You also may record the provision when you are, for example, expecting any, for example, liability to be, of course, incurred because of any environmental damage you caused, of course, and you are, let's say, required to correct for that damage. Okay. So we'll see for these common types of obligations, of course, specifically these provisions, we'll see what will be the accounting treatment. Okay, so in general, how to recognize a provision. Okay, so it's not really, as I said, provision, it's kind, as I said, of, let's say, specific type of liability. And the most of cases, if they are, for example, as businesses, if I'm free to recognize anything as a provision, etc., as a liability and so on, so I recognize expense in the debit and credit or liability account in the form of provision, it will open the door to earnings manipulation, because just keep in mind that if I will debit an expense account and a related liability account, I will what? I will increase my total expenses, I will decrease my net income, so my taxes payable will be also lower, and so on. Okay, so as businesses, it can be maybe one way to what? To reduce my net income, to reduce my my payment, of course, of taxes, etc. So this is really, there is a room to what? To tax dodging, and also to earnings manipulation. Okay, so for that reason here, we have specific conditions, let's say strict conditions that should be met to be able to recognize a provision in your financial statement. So businesses, they are not free to do as it please them. Okay, so they have well, there is a possibility that if you have this uncertainty regarding some timing or amount, that you will still record it a liability, but under certain conditions. So there are 3 conditions that should be met. What is the first one? Here, still, you should have a present obligation, and this obligation can be in the form of legal or constructive. So we'll see what is legal and constructive. And of course, this present obligation is resulting from a past event. So that's, let's say, the first part of a definition of a liability. The second is that we said that in the prior slides, present obligation that will make what? An outflow of resources was certain when we talk about, in general, about liability. But now you are allowed to recognize a provision, and of course here record the liability if there is a probable. So probable will be an outflow of resources that will be required to settle the obligation. So here you have a probability. And again, when we talk about probability in accounting, so here we say more likely than not. And when we say more likely than not, so it's meaning more than 50% in most of cases. We'll see if in other examples maybe higher. Okay. So here there is a probability that you will consume your resources, your asset to settle that obligation. And the third condition, you be able to make a reliable estimate. So here we have not an accurate amount, for example, not like accounts payable when you purchase an account for $10,000. Now you are required to just provide a reliable estimate. For example, for this litigation, I have a reliable estimate that I will be paying damages to that employee that I fired, etc. I don't know, $50,000. Okay, so that's a reliable estimate that can be made. Okay, so here again, I'm not allowed to record any type of provision unless it is clear that I have a present obligation. It can be legal or constructive. Of course, this obligation resulted from a past event. We have a probability of outflow of resources that are expected. Why? Because to settle that obligation, and of course a reliable estimate can be made. So here we're talking about reliable and estimate. Okay, so here we have estimates, and this estimation is reliable, so meaning let's say fairly accurate regarding, of course, that event. Okay, let's see here the situation of provision here with the example of warranty. Okay, so Santos SA gives warranties to its customers related to the sale of its electrical product. The warranties are for 3 years from the date of the sale. So based on past experience, it is proper, so here more likely than not, that there will be some claims under the warranties. Okay, so here we assume that the reliable estimate of the amount of the obligation can be determined. Okay, so the question is, should Santos recognize at the statement of financial position date a provision for the warranty cost yet to be settled? So here we should just try to apply the definition of a liability, and in particular the 3 conditions for a provision to be recorded to this situation. Do we have a present obligation? Yes. So here the warranty, that's a present obligation as a result of what? Of past obligating events. So you have a past obligating event because here you use it actually to give warranties to your customers. So based on experience, when you purchase a product from that centers, etc., you expect that you will also benefit from that warranty period, etc. So you, as of course a seller, the warranty now is a present obligation for you. It is resulting from past obligating event. Okay, as I said, the past obligating event used to sell a product with a warranty. So this is actually what we call a legal obligation. So giving rise to legal obligation. So legal obligation, that is what we qualify as legal obligation. It was actually an obligation that is generated or that rises because of your old, let's say, way of doing business, your old prior experience, etc. And of course, the warranty will result of what? So when you have that present obligation and you will be settling this present obligation, it will result in an outflow of resources embodying benefits in the settlement. Because why? Because you will have maybe probably, there is a probability that will be some claims under the warranties. You may be asked, for example, to just, I don't know, replace what was purchased or repair it or whatever, okay? So you will be using some of your resources to satisfy these claims that are likely to be probable here. Of course, to be used based, of course, on also prior experience. Added to that, of course, the amount, it is estimated to be a reliable here estimate of the amount. If we can reliably estimate how much, for example, warranty expense and liability, of course, we should then recognize it based on that past experience. Okay, for example, we can just record warranty expense and warranty liability with, for example, $10,000. Okay. When we talk about constructive obligation here, so here we're talking about, so please, when we talk about legal obligations, of course, use it to make sales with warranty, but this is, of course, expressed in terms of the contract with the customers. Okay, so there is a legal obligation. You will, like we used, when you purchase any, for example, electronical engine, whatever, you will have this document for warranty, etc. That's a legal obligation. Okay, here, let's say it is implicit, more implicit. Why implicit? Because you have this constructive obligation when there is an established pattern of past practice, of published policies, of sufficiently specific current statement, etc., but that the company has indicated to other parties that it will accept certain responsibility, and as a result, the company has created a valid expectation on the part of those other parties that will discharge those responsibility. I don't know, for example, just trying to figure out one example of this constructive obligation. For example, some businesses, maybe they will be saying that you will have, I don't know, you will be using that product, and any deficiencies, etc., they will be challenging you if there will be any deficiency. Otherwise, of course, you will be refunded, or you will be getting, as I said, a new product. Okay, so there is no legal obligation that is actually binding here. Okay, but still, this firm is already known that, of course, these are their practices. You will get their product, you will enjoy, of course, the quality in this product, etc. But in cases that there is a problem, you will know that you will be quickly here settled, of course, this problem by just changing or repairing and so on. Okay. So this is the kind of constructive obligation when it is based on more on practice, on maybe a reputation of the firm, more than a binding here contract or document, etc. Okay. So this is an example here for these warranties and for this constructive obligation here. Okay, so Christian Dior here has a policy of refunding purchases to dissatisfied customers, even though it is under no legal obligation to do so. Its policy of making refunds in general, no. And this is not only the situation for Christian Dior. Actually, all the, let's say, prêt-à-porter firms in developed countries, in France or in other, of course, countries, you have 30 days to return them back, and you will be fully refunded. You may be unsatisfied, of course, with the quality, with the maybe the type, the shape, all any other, of course, issues regarding your purchase. You will be able to be return it back, and of course you will be refunded. Okay, so in this situation, if as a Christian Dior or any other, of course, firm, I'm selling these, of course, items, and of course I have that policy of refunding purchases to dissatisfied customers, and it is actually a policy that I'm really making. So I have a reputation that any dissatisfied client will be refunded. Okay, so in this situation, should I record it as provision any of these refunds? So after all, I didn't refund yet. There is there any obligation, a present obligation? Is there is any probability to refund or not? And the amount will be reliably estimated. if we assume that the reliable estimate of the amount of the obligation can be determined. What do you think here? Should it be reported as a provision and of course as a liability or not, this kind of provision? Well, yes, good. Yes, it is here a liability. Why? Because we have a present obligation, and that's a constructive obligation, okay? So it is resulting from a past obligating event, where the sale of the product. So this is, as I said, the constructive obligation, because that's the history of the company that really created that expectation from customers that they don't really, they are not, let's say, the or to be refunded, etc. Okay, so they don't have any problem with that. Okay, so of course any probable refund will result of this outflow of of resources in the settlement. So in this situation for Christian Dior, they used to maybe get some of their goods returned back for refund. So there is that probability, more likely than not. And then of course, if there is this probability of more likely than not, of course we should record it as a liability, in particular, of course, as a provision, and of course when we have a reliable estimate of the cost of these refunds. Okay. Here we have another example of a provision for lawsuit here. Okay, assume that an employee filed a £1 million lawsuit on November 30 against Morrisons Supermarkets for damages suffered when the employee slipped and suffered a serious injury at one of the company's facilities. Morrisons lawyers believe that Morrison would not lose the lawsuit, putting the probability of future payment at less than 50%. So here's this thing here. Should we recognize here as a Morrison, of course, a provision for these legal claims at December 31? Of course, assuming that there is a reliable estimate of the amount of the obligation can be determined. What do you think?
It's not probable.
Yes, so it is not probable because it said that it is less than 50%. As I said, probable meaning more likely than not, meaning that it is more than 50% here as a probability. So if it is less than 50% here, so there is no here, no provision to be recorded. Okay, so even though we have this obligating, of course, past obligating event, because here the injury that led, of course, to the filing of this lawsuit, as firm as this, of course, estimated by its lawyer, it is more likely than not that, of course, we won't pay any damages. Okay, so I don't need to record it as a provision. Okay, if it is the opposite, actually, Morrison lawyer determined that they will be losing the lawsuit here. There is a probability they will be losing, of course, the lawsuit. There is probability that they will be paying, of course, this amount, and the probability, of course, it is more than 50%. Okay, so if it is the case in the opposite, of course, situation, it should be recorded as a liability, and of course, it should be reported as a provision here. Okay, because here we have low probability. That is not more likely than not, of course, then it should not be reported. You may tell me I cannot record it, of course, as a liability, but at the same time I have a situation that's, of course, the situation of an event that occurred in this company's facilities. We have a lawsuit that is still we have an uncertain outcome for this lawsuit. You as a firm, if you are, for example, adapt to the full disclosure, you may just provide details in your notes disclosure or any other party, of course, in your annual report, to talk about maybe this lawsuit and maybe the outcome of this lawsuit, as maybe your lawyer recommending. Okay, so it doesn't exclude the fact that even if you won't include it in your financial statement, that you should not report. Okay, you should may disclose this kind of information, notes disclosures. Okay. Okay, so these are examples on different types of provisions and how we should report them, of course, in particular when we have the three conditions that they are met. Okay, remember, three conditions, which are we have a present obligation emanating, of course, from past obligating events. It can be, of course, legal obligation or constructive obligation. Of course, the settlement of this obligation will make probable use or consumption of resources, use up, of course, of assets, and of course the amount will be reliably estimated. So here we have estimate, we can have an estimation about regarding the amount. Okay, so for IFRSs, how, when we say reliable estimate, so how to report this amount, of course, for provision. Okay, so when we say reliable estimate, so here we are meaning what? The best estimate of the expenditure required to settle the present obligation. So as, of course, as a business, as a firm, if I already met all the three conditions and I should report a provision in my, of course, within the liability section, I should be able to present what? The best estimate of the expenditure required, of course, to settle the present obligation. Okay. So what is the best estimate? So here that will be the amount that I'm expecting to pay to settle that obligation at the statement of financial position date. So at December 31, at this, of course, time, how much I'm expecting to pay, for example, to settle the litigation with the employee, or for example, with his warranty, with the customers, or with, for example, environmental damages, etc. Okay, so I should proceed with the best estimate, most, let's say, accurate possible here estimate for that liability. Okay, so that's really important. Okay, because one of the important, or let's say basic accounting rule is that an item that should be recognized when it is reliably estimated. Okay, so a reliable measure or reliable estimate, that's one of the, let's say, building blocks of recording one item. Okay, if one item cannot accurately be measured, cannot be reliably estimated, then it should not be part of the financial statements. Okay, let's see example here of measurement of provisions with the different common types of provisions. Okay, so here we'll see in details the different types. We'll be talking about warranties and environmental damages and litigations and so on. Okay, so what was just explained in prior slides, that just here, let's see an avant-goût, just explanation, of course, on how we will apply the definition and the three conditions to be met to be recorded as a liability. So here we have this measurement example. So management must use judgment based on past or similar transactions, discussion with expert, and any other pertinent information. Of course, the measurement, that's really challenging, because it said that you should have provided reliable estimate, which is the best estimate of the expenditures that you are likely to incur to settle, of course, that liability. And this best estimate, of course, is done at the statement of financial position date. Okay, so when you say the best estimate, you should, of course, rely on judgment, professional, of course, judgment, and this professional judgment will be based on what? On past events, past circumstances, similar transactions, when you will be also calling for experts that will, of course, giving, of course, their let's say appraisal, their valuation. There may be expertise regarding, for example, how much it will be, for example, costing you to let's say to settle the damages, environmental damages, or any litigation, etc. Okay, and any other, of course, pertinent information, any type of information that is really relevant for you to help you make this best estimate, of course, as accurate as possible. Okay. Here we have example of the Toyota warranties. Okay, so Toyota here might determine that 80% of its cars will not have any warranty costs, even though, of course, you are offering this warranty, this guarantee actually, to all of your customers. But based on your past experience, you determine that 80% of your cars will not have any warranty costs, but still 12% will have substantial cost and 8% will have a much smaller cost. Okay, so in this situation, by weighting all the possible outcomes by their associated probabilities, Toyota will arrive at an expected value for its warranty liability. So here we'll be using what? This weighted average method, this weighted possible outcome to get, of course, this expected value of its warranty liability. So simply by just weighting here the percentage or the probability of any cost to the estimated cost to end up, of course, with this warranty amount. Okay. Another example for Carrefour, for example, here Carrefour will sell many items at varying selling prices. Refund to customers for products sold may be viewed as a continuous range of refunds, with each point in the range having the same probability of occurrence. In this case, the midpoint in the range can be used as the basis for measuring the amount of the refund. Okay, so here when we have really this continuous situation of refunding, and when you have really many items that are sold at different selling prices, so here we're talking about taking the median, of course, in the range as the basis for measuring the amount of the refunds. Okay, so these are just examples of practical examples on how reliable estimates of these provisions can be measured. For example, for warranty, for refunds here, for lawsuit. Large companies like Novartis are involved in numerous litigation issues related to their products. Where a single obligation such as a lawsuit is being measured, the most likely outcome of the lawsuit may be the best estimate of the liability. So here, of course, we have, let's say for a lawsuit, we have different scenarios, and we just need to pick the most likely outcome. Okay, what is the scenario that is really more probable regarding, of course, the outcome of that, of that lawsuit, compared, of course, to the other scenarios. Okay. So in general, the measurement of the liability should consider the time value of money if material. So here, when we're talking, for example, of long-term liabilities, long-term provisions, so it's and of course, when you have this time value of money, that will be really important factor that should be taken into consideration. So if it is material, okay. But if you are talking about, for example, let's say short-term provisions, in general, for short-time liabilities in general, this time value of money is not taken into consideration. Okay, so we are not making this discounted present value measurement, etc. Okay. So any future event that may have an impact on the measurement of the cost should be considered. Okay, any maybe I don't know, substantial rise of inflation. So this will make, of course, this situation of measuring the discounted year present value of this amount, of course, that will be material. Okay, so that's some examples on how, as I said, the amount can be reliably estimated, can be this best estimate possible. Okay. So in addition, of course, to making recording, of course, when the three conditions are met, we will be debiting an expense account and crediting the related liability account. Still, IFRS requires extensive disclosure related to provisions in the notes to the financial statements. So companies do not record or report in the notes general risk contingencies inherent in business operations. So here we're talking about these general risks. They are not provisions. Okay, so when you have this possibility of war or strike or uninsurable catastrophes or business recessions, they are not they are contingencies, and of course contingencies that should not be a part of your financial statements. They can be just, you can make note disclosure, but without of course including this, for example, contingencies in your financial statement, in the balance sheet, or in the income statements. Okay. Okay, so so let's see, as I said, in details, these common types of provisions and what will be the accounting treatment. Okay, so starting here by the litigation provisions. So companies must consider the following in determining whether to record a liability with respect to pending or threatening litigation and actual possible claims and assessment. Okay, so as a firm, I should see if I will be recording a liability for any pending or any threat of litigation, and of course based on actual or possible claims and assessment. Okay, so here I should, if I will be recording the liability with respect to this pending or threatened litigation, I should not forget that the time period in which the underlying cause of action occurred. Meaning what? So when for example, I just fired my employee in 2021 and he filed, for example, this lawsuit, litigation, etc. So if I will be, of course, if I meet the three conditions, if I will be reporting a provision, should be done in 2021, of course, financial statement. I should not report them, of course, in the next year, okay? So I should, the time period is really important. So in which the underlying cause of action occurred, that's important, not when, of course, the settlement will be occurring. And the second is that the probability of any unfavorable outcome, okay? That's also the most likely than not, of course, situation. And also, as we said, if it is reasonable estimate, it's possible to have this reasonable estimate or not, okay? So they able to make reasonable estimate of the amount of loss. So هنا نحكي please على losses, of course, because here we're talking about litigation provisions, and you know, for provisions they are really with this negative, let's say, tones regarding business, because after all there will be what? There will be outflow of resources. That's why, of course, it will be kind of losses for businesses, okay? So this is the situation for litigations and regarding, of course, lawsuit that they are filed. So they are, of course, threatening or they are pending. But in situation that you have still unfilled suits or unasserted claims and assessments, so here should determine what? The degree of probability that the suit may be filled or claim or assessment may be asserted, and also the probability of unfavorable outcome. So if they are both probable, and if the loss is reasonably estimated, so still here we have this possibility to make this best estimate possible. If the cause of action is dated or before the date of the financial statement, then the company should accrue the liability. So what is said here, please? In the prior example here, we're talking about already pending, so already filled litigation, or threatened, of course, that they are, as I said, in the process, etc. Okay, so meaning at the ending, the end of the process, etc. And we have this actual claims or assessments. So you have, for example, ideas about the possible damages, etc. Okay, or fees that should be paid. So you are, of course, you are allowed to record it as provision. Of course, taking into consideration the time period in which, of course, this causing, let's say, action occurred. Of course, taking into consideration that this pending, of course, litigation will have this unfavorable outcome, you will be, for example, called to pay damages and fees to this, for example, ex-employee. And of course, based on the condition that you will have this ability to make this reasonable estimate. But now, what if the client that you, the customer that you just fired didn't file yet a suit, but you have, of course, probability, you doubt that there is really a certain degree of probability that this suit may be filed. There will be, of course, claims and assessment that will be asserted, of course, based on this probable suit. And also, there is also probability that this probable feeling of suit will also have this unfavorable outcome. And of course, if both, of course, they are reasonably estimate here, the loss is reasonably estimate, then also you should record here a liability, of course, conditioned on what? On the cause of action here was dated on or before here the date of the financial statement. So this is what I said, the time period is important. So I cannot, for example, record it if, for example, this probability and this loss is estimated, they are not being estimated, of course, in 2021. There will be, for example, the probability will be, let's say, met here condition in 2022, not 2021. So here it's important. If there is a probability for a lawsuit, if there is probability that you will have to pay for damages, so this is the unfavorable outcome. If the amount will be reasonably estimated, okay? So here, and these are, of course, the details. They are what? And of course, the cause of action here, the past, talking about in particular the past event. Okay, so here the event is actually occurring on or before the statement of financial position dates. Then of course we should here accrue a liability, so we should record it as a liability. Okay, here we have just a small example regarding how to record these litigation provisions. So we have Sources is involved in a lawsuit at December 31. Prepare the December 31 entry, assuming it's probable that the Sources will be liable for 900,000 lira, Turkish lira, I guess, as a result of this suit. And then, of course, prepare December 31, if any, assuming it is not probable that the Sources will be liable for any payment as a result of this suit. So here what? We have a lawsuit already. So we have this pending lawsuit. We are assuming that there is this unfavorable outcome, and it is, of course, reliably estimated to be 900. So at this level, of course, we should debit lawsuit loss, which is other income and expense account. So lawsuit loss by 900, and of course litigation here or lawsuit liability here by 900. So here you see we will of course accrue liability because here of this situation. Now, if it is not probable that there will be liable for that amount, meaning there is let's see, this unfavorable outcome is not probable. So at this level, there is no entry, okay? So the loss won't be accrued because there is no probability for liability at December here 31. You see here the difference? So if I'm not liable to any of the amount and there is no probable here unfavorable outcome, then I should not record it as provision. The next type of provisions, these warranties provisions, okay? So what is in general definition of warranties? They are promise made by a seller to a buyer to make good on the deficiencies of quality, quantity, or performance in a product. So you will be, of course, purchasing a product from a seller, and the seller, of course, making promise that any defectious product, any problem with the quality, etc., will be repaired or will be changed, etc. Okay. So if it is probable that the customer will make warranty claims and the company can reasonably estimate the cost involved, then the company should record it as an expense, and of course, and related liability will also arise. Okay, so here remember again, so here if there is a probability that the customer will make the claims and also we can reliably estimate or reasonably estimate the cost, then we should record it as an expense here. So for businesses, we have two types of warranties. We have the product warranty, what we call it assurance types, and also the service type warranty. Okay, so what is assurance type warranty? That's a quality guarantee that the good or service is free from defects at the point of the sale. Okay, so that's the assurance type warranty that is offered at the same time, of course, when you purchase the product, and of course it is like included in the selling price. Okay, so of course at the time of the sale I should also record an obligation, and of course I should debit an expenses, warranty expense, in the period, of course, the goods are provided or services are performed, so at the point of the sale. So here, when you are providing an insurance type warranty, you purchase, for example, a TV or, I don't know, a laptop, and you are offered a 1-year guarantee. So at the point of the sale, as a seller, of course, I should debit an expense and a liability, of course, account, okay, in the form of warranty liability, okay? And this is an example of this assurance type warranty. So Denson Machinery here company begins production of a new machine in July 2019 and sells 100 of these machines for 5,000 cash per year end. Each machine is under warranty for 1 year. Denson estimate based on past experience with similar machines that the warranty cost will average 200 per unit. Further, as a result of parts replacement and services performed in compliance with the machinery warranties, it incurs 4,000 in warranty costs in 2019 and 16,000 in 2020. So here, the situation is that you will have what? You have to accrue for this warranty liability and expense, of course, at the date of the sale, and then, of course, the incurred cost for 2019 and 2020, okay? So what are the journal entries for the sale and also for the related warranty cost? So at the time of the sale, you should recognize what? The sale of this machine and also to accrue for the warranty liability, okay? So here we have what? We have a sales of 100 of these machines for 5,000. and we have experienced that the warranty cost will average 200 per unit. Okay, so July to December 31, we have what? We have debit cash. That's of course the sales revenue. So the again 5,000 times the 100, so the 5,000, and that's of course sales revenue for 500,000. Okay, now you have to record the payments for warranties included here. Okay, incurred. So here we have estimation of 200 for per one item. Okay, it's about here the incurrence before the recognition. Excuse me, so just to go back. Yes. So further, as a result of part replacement and services performed here, it incurs 4,000. This is the incurrence, of course, of warranty expenses. Okay, so when you have warranty expense here for here December 2019, it was 4,000. Of course, you have already paid for that as cash, for example, refunding, or I don't know, replacing or purchasing, let's say, replacing here product, partial product, etc., or items, etc. So the thing is that here you already incurred 4,000 during 2019, okay, and that's 4,000 that you already expensed, okay. At the same time here, you'll have what? You have remaining expected warranty claims in 2020, okay, so you'll make adjusting entries for this expected warranty in 2020, okay. So expectation, it's about 16,000, so I have to debit warranty expense and warranty liability for 16,000 here. It's about what? It's about the 16,000 here remaining from the 20,000. Please, one remark. Ahna, it said that here, if you go back to this, of course, illustration, it said that based on past experience with similar machine, that the warranty cost will average 200 per unit. Okay, donc هنا please ما عملناش why we didn't make any for example journal entry regarding these 20,000 those as warranty liability, because this is the first thing, this is the assurance type warranty, and the warranty liability is actually part of the selling price. Okay, donc we should first of all accrue صار عندنا البيمنت متاع or the incurrence of cost of warranty costs during 2019. This is what was done here. Still احنا عندنا estimation of it is $20,000, so still عندنا 16,000 that they will be remaining for the next year. So as a journal adjusting entry here, we just adjust for the expected warranty by recording warranty liability. Okay, so that's of course for the remaining warranty liability for the future, because the actual year already incurred. Okay, that's why there is no warranty liability of 4,000 here for the current period. Okay, it wasn't a liability because it's already incurred and already done with it. Okay, you see here we have just an expense and we just credited accrued maybe account payable, inventory, cash, or whatever. Okay, so that's the main remark. So December 31, what will be the statement of financial position showing here? We have a warranty liability, current one by 16, and of course for the income statement we have what? Warranty expense of the entire year of 20,000, because they have 16 and they have the 4,000, and we have also sales revenue for 500,000. Okay. So when we incur now this warranty cost in 2020, so we simply what? Will debit warranty liability, so there is no longer liability here for 16, and of course we credit cash, etc. So this is for the incurrence of this warranty liability in 2020. Okay, so at the end of 2020 there is no other warranty liability to be reported for this machinery that is sold in 2019. So we already incurred and already all the warranty costs were included and also settled. Okay, as the liability was settled. Okay, so this is about the assurance type. Okay, let's see now when we talk about the service type warranty. So what is a service type? So this is an extended warranty on the product at an additional cost. So it is not really, يعني احنا what is the difference between assurance type and service type? If you purchase, for example, I don't know, a TV, and you are offered 1 year here of assurance type, and of course the selling price that's the same. يعني when you purchase a TV, for example, for $1,000, let's say smart TV for I don't know قديش 50 cents or whatever, or يمكن يسميوها. So this TV, you paid for that TV for $1,000, and of course this is the selling price, and this is of course including this the assurance type warranty. So you didn't pay extra money for this warranty. It was offered, given of course the selling price by that firm. Now you can also ask for any extended warranty on the product, but at an additional cost. You may, for example, ask for additional 2 years of warranty, but of course you will have to pay extra amount or additional, of course, money for that service type warranty. Okay. So of course, if you have to pay extra money to that firm, the firm will be what? Collecting monies, of course. For what? For future services. That's why it should be recorded as an earned warranty revenue. Okay, so it is an earned warranty revenue account that will be used, of course, to be credited for that cash collected, and then of course it will be debited once this unearned warranty revenue will be converted into warranty revenue, when of course the claims will be, or of course this warranty will be used by customers. Okay, so it will be recognized as revenue on a straight line basis over the period the service type warranty here is in effect. So here, for example, if you have this 2 years additional here warranty, every year of course you will have, for example, to amortize here, or to recognize this. So meaning you will debit unearned warranty revenue, and you credit warranty revenue for example, half of the amount here. Okay, we have an example of this service type warranty. Please, are you following? هسه في monologue أنا برك نحكي. There is no feedback, no interaction. Are you there? Are you following? Okay, hopefully everything is clear. But we have the situation of you purchased an automobile from Hamlin Auto for $30,000 on January 2019. Hamlin estimated the assurance type warranty cost on the automobile to be $700. So Hamlin will pay for repairs for the first 36 miles or 3 years, whichever comes first. You also purchase for $900 a service type warranty for an additional 3 years or 36,000 miles. Hamlin incurs warranty costs related to the assurance type warranty of $500 in 2019 and $200 in 2020. Hamlin record revenues on this service type warranty on a straight line basis. So what will be the entries that should be made in 2019 and 2022? So here's the thing: you purchase an automobile, so you will benefit from an insurance type, but you also contracted a service type here warranty. Okay, so as a Hamlin here, as of course a seller in this situation, I should what? I should account for the warranty costs that I incurred in 2019. I should also accrue the warranty liability that I will be incurring in 2020. At the same time, I should record in 2019 what I collected as an earned warranty revenue. That's about, of course, this service type warranty. And then, of course, I should what? I should, let's say, record the revenues here on a straight line basis, so over 3 years. Okay, so I have the list of journal entries to perform. So the first here, let's record the sale of the automobile here. Okay, so it was on January 2nd. We have the sale of automobile for $30,000. So we have here, let's say, some cash, and but here cash was collected for the sale of the automobile, but also for this service type warranty. So this additional here amount that I collected from customers. So I collected 30,900. So among the 30,900, I have 30,000 as revenue, sales revenue, and I have 900 as an earned warranty revenue. So this was collected on January 2nd. Okay. So from January 2nd to December 31 here, there are warranty costs that were incurred, okay? So here we have to debit warranty expense for this 500 incurred, and of course we should credit cash or accounts payable or inventory, whatever here, account to be credited, of course, for that warranty expense incurred. Still, we should adjust for what? For the future warranty liability that will be incurred in 2020. So here we have expected assurance warranty. It said here it's about so we incurred 500 and 200 in 2020, so we should record warranty liability for 200 here. That's the adjusting entry. So here we have to debit warranty expense and warranty liability for 200. That's of course so December 31, 2019, what I have only warranty liability for 200. And of course, the income statement will be reporting what? Will be reporting warranty liability for 700. That's the 200 plus the 500. But also it will be reporting sales revenues for $30,000 or euro. Okay. So that's December 31, 2019. Now, December 31, 2022. Here we're talking about recording revenue recognized on the service type warranty. So here, remember, قلنا this unearned warranty revenue should be recognized, of course, as revenue on a straight line basis. So every year we should, it was 3 years service type warranty for 3 years. So every year we should record this portion of 300. Okay. So normally in 2020 we recorded 300, 2021 we recorded 300, and then of course the 2022 here we also debit the unearned warranty revenue for 300 and record the warranty revenue for 300. Okay. So the warranty cost under the service type here will be, let's say, it will be expensed as incurred here from 2022 to 2024. Because, you know, علاش 2022 to 2024? Because the assurance or the service type warranty here is expected to start, let's say, being incurred and even let's say amortized over 3 years. After what? After the end of the first assurance type warranty. Okay, so the assurance type here it was 3 years. That's why, of course, from 2019 to 2022 we have this assurance type, and then from 22 to, let's say, this extra 3 years to 24, that's of course the service warranty that was purchased as additional here amount paid to the firm. Okay. So whenever we have any warranty cost that we incur for this service type warranty, what we do is we debit warranty expense and we credit, of course, cash or inventory or whatever every year from 2022 to 2024. Okay, so that's what will be done. And as I said, this, of course, journal entry will be made also every December 31, 2023 and 2024 here. Okay, because this as I said, service warranty revenues will be collected or will be recognized with the passage of time, so starting from 2022. Okay.
Madam,
yes.
The remaining 200 from the first 700 will be recorded on the 31st of December 2020.
هذه 200.
Yeah, we will have it in the 31st of December 2020 as no. Warranty liability, and then cash inventory and accrued payroll, the remaining one.
احنا in December 31, 2019 we recognized that we have a remaining liability of 200. So here in 2020 normally it was incurred as cost. Okay, so normally during, for example, 2020 it can be, I don't know, January or March or June or whatever, and any date when of course it was incurred by the customers and there are claims regarding that amount of liability. So we will debit warranty liability during 2020, of course, and we will credit cash or inventory or accounts payable, whatever. Okay, so warranty liability here, if it will be incurred in 2020, it should not, of course, there is no warranty liability here. Again, it should be let's say offset. Okay, so this 200 will be debited. So warranty liability will be debited, and of course cash, inventory or accounts payable, etc., will be credited for 200. So this is of course expected to be settled in 2020, and this is how we settle the liability. Okay, so we'll debit the liability and we'll credit the related here account as cash or inventory or any accrued here accrual payment. Okay.
Yes, okay, clear.
Okay, good. Now, what about the consideration payable here? Let's just please, we don't have enough time. Control register contingencies, and then we will close this chapter. Okay. It's about when you have. It's really a little bit tricky. It will be time consuming to explain, and this is just about when you have, for example, I don't know, you are making to boost your sales, so you will be offering, for example, one item as free if you, for example, purchase one item or two items. The third will be offered for free, or will be offered, for example, for a lower price, etc. Okay, so this is issue that we should just outstep. So here, just to tell you that for consideration payable, it's not included. Okay. So now from 69 to 74. Okay. To 75. Yes. 275. Okay. Let's see the last type here for common. Here type of provision, the environmental provision, that's important also. So we have seen the litigation, we have seen the warranty liability, and now we will see the environmental here provisions. Okay. So for environmental provisions, as a firm, they must, of course, recognize an environmental liability when it has an existing legal obligation associated with the retirement of a long-lived asset, and when it can reasonably estimate the amount of the liability. So imagine, for example, you are, I don't know, you are, let's say, an oil company, and you're making, you are using, for example, a site, etc., to, I don't know, to all your activities of looking for oil in the ground and so on. So remember, you have all of your machinery, all of the stuff needed, of course, for this exploration activities, etc. And then, of course, you have, for example, you are allowed for, I don't know, to undertake all of this, of course, exploration activities during, for example, 5 years. And then you have what? A legal obligation to end up your exploration within the 5 years. So you will have what? To retire this long-lived asset. So you will dispose of this asset that you use it for this exploration, of course, activities. And then, of course, the retirement will have to what? To take into consideration, of course, the environmental issues. Okay. So if you are in that situation, you have this legal obligation that is associated with retiring a long-lived asset, and you can reasonably estimate, of course, the amount of that liability, then you should record an environmental liability. So you should account for it. Okay. Let's see here the example of this obligating event or legal obligation that is existing regarding the environmental provisions. Okay, when, for example, you have this legal obligation for decommissioning nuclear facilities. So you have nuclear facilities and you are obliged to, let's say, take them off from the site that were, for example, installed. When you have to dismantle, restore, and reclaim of oil and gas properties. So this is just the example that I gave. When you have to dismantle, so to retire all the maybe a long-lived asset that you used for exploring any oil and gas here presence in that of course properties. When you make certain closure, reclamation, and removal cost of mining facilities. So also when you have a mining site that you already not exposed, use it all the, let's say, the mining or, for example, gold or any other types of course of mining facilities, and you already you are done with that site, so you have to make any removal of all what you just installed. You will close actually that site, so you will incur cost And that's, of course, an example of environmental here provision that you will be recognizing, okay? When you also have this legal obligation for closure and post-closure cost of landfills. You may, for example, would be called not only to close the site, but also to improve the mega landfills. So you will be restoring lands or sites or any facilities regarding after taking off all your long-lived asset and removing, you know, the remaining of your activities, okay? So there are the types of where businesses should recognize this type of provision. This is the environmental provisions, okay? So how we can measure that environmental provision, okay? It is measured, of course, based on what? On best estimate of its future cost. So I should be able to make a best estimate of any future costs related to this dismantling, closure, as I said, landfilling, all of these activities that are related, of course, to this type of, let's say, mining, oil exploration activities, etc. Okay, so if we are, of course, in that situation and we have this legal obligation and we have, it's possible to get this best estimate of its future cost. So here the environmental liability will include what? The cost associated with the environmental liability in the carrying amount of the related living asset here, and also a liability for the same amount here should be recorded, okay? So the company will record what? Here it's about, of course, the carrying amount of the long-lived asset and also a liability for that amount. We'll see an example, okay? So Wildcat Oil Company here erected an oil platform in the Gulf of Mexico. Wildcat is legally required to dismantle and remove the platform at the end of its useful life, estimated to be 5 years. Wildcat estimates that dismantling and removal will cost 1 million. Based on a 10% discount rate, the fair value of the environmental liability estimated to be, you see here, so that's, of course, the future, of course, the best estimator of the future cost of 1 million, but because it is, of course, the useful life here is 5 years, so it will be after 5 years. You see here, we are taking into consideration the time value of money, okay? So here we have what we have to measure the discounted present value of this 1 million. So it is estimated to be 620,000. Okay. So what will be the recorded liability here on January? So we'll debit, of course, drilling platform. So this is how to say here. We have what? Here we have this asset, long-lived asset, that will be debited, and of course environmental liability that will be credited. Okay, so this is the meaning, but recognizing, so the journal entry will include what? Will include this long-lived asset, of course, carrying value, and of course the related environmental liability here as credit here. Okay, so this is how to record this environmental liability because of this long-lived asset that is installed in all this platform in this example in the Gulf of Mexico. Okay, so if you have an estimation that we will have or will incur 1 million cost to remove that platform, then of course we should recognize at the beginning here, January 2019, here the asset itself here with 620 and the environmental liability with the same here amount. Okay, and then during the life of the asset will be what? Will be depreciating or retiring here the cost to expense. So this is, of course, the depreciation, but here it's not really depreciation, but here we're talking about retiring cost to expenses, because after the useful life here we will be disposing of, so we'll be retiring, so there is no we'll just dismantle, remove, etc. Okay, so if we'll be using the straight line method, what will be the journal entries here to be recorded? So we'll debit depreciation expense, as I said, so will be, of course, the 620 over 5 years, and we credit what? Accumulated depreciation for that plant asset. Okay, so that's how let's say this environmental liability will be what? Will be recorded and amortized as expense over the useful life of that asset. Okay, so in addition, of course, to that, of course, depreciation expense, we have to accrue for the interest expense. علاش accrue interest expense? Can you tell me if you are following? كانكم فايقين surtout. No answer? Hi, Mary. Try to guess. Wala Rami, if you are still there.
And then the question is, why is it accrued?
Why we have to accrue, يعني meaning to record interest expense here in each period? Yeah, the answer would have been, I think, simple for you because you are mostly having minor or major finance, okay? Now still, why? Because احنا هنا we are taking into consideration the time value of money, because the present value here, that is 620, is different from the face value that will be what? That's the 1 million, will be the cost of removal after 5 years. So we should record interest expense every year to what? To increase the present value of this environmental liability until it will meet the 1 million of its cost, of course, after 5 years of using that platform, okay? So that's why, so here we are talking about the process of amortization of this, let's say, this liability, okay? So we'll be increasing the interest, of course, with the amount of interest expense until the present value will be equal to the face value, okay? So here we have interest expense that is of 10%. هنا خديناه, of course, احنا حسبنا the present value, it was at 10% discount rate, okay? So here we should, of course, use the discount rate here of 10% times, of course, the present value, and then, of course, the environmental liability will be increased by 62, okay? So at the end here, so this will be, of course, done every year. But of course, it won't be 620 times the 10%. It will be 620 plus 62 times the 10%. That's the new amount of interest expense, and what will be also the new amount to be credited to environmental liability. So we'll be do the same from December 31, 2019 until 2024 or 2023. You just need to measure for 5 years until what? Until we have this 1 million. Already the environmental liability is equal to 1 million as it is provided here in this illustration. What I said now, on January 10, 2024, WorldCat contract with reclaimers to dismantle the platform at a contract price of 995. So here we have what? We have a settlement of this liability on January 10, 2024, okay? So here we already incurred the cost of this settlement of this liability. So we will debit environmental liability for 1 million. We will also credit the gain on settlement because what? We already recorded liability at 1 million, but we succeeded to have a contract for 925. So we got a gain on settlement for 5,000 and we have cash for this $995,000. Okay, so you see here, to be able to debit environmental liability at 1 million at its face value, we should have already what? Amortized the interest here expense over the useful life. So by making this amortization here process of measuring, of course, interest expense and increasing the environmental liability, so the amortization of the present value of this environmental liability until we meet the face value, okay? We will use all of these techniques also in chapter 14, chapter 17, etc. So you will have more details regarding this issue of amortization of carrying value, etc. when it is, of course, discount, premium, and so on, okay? You have also some situations when you have also to record the provisions when it's about an onerous contract, okay? What is an onerous contract? When you have an avoidable cost of meeting the obligation that is exceeding the economic benefits expected to be received, okay? So here you have actually really a contract with what? Binding contract that any if you are not meeting, for example, the obligation within the contract, the cost of not meeting are exceeding actually the economic benefits, okay, from that contract, okay? So here, when we're talking about how to qualify or how to measure that type of provisions, we should what? The cost should reflect here the least net cost of exiting here from the contract, which is lower of the cost of fulfilling the contract. Or so how we know, how we value this expected here cost. So here we should be the lower between what? The cost of fulfilling the contract or the compensation or penalties arising from failure to fulfill the contract. Okay, so you can have this contract with another party, and you have really severe here rules. If, for example, if you don't fulfill the contract, you will be subject to paying, of course, penalties, etc. So that's why when you fail to fulfill the contract, or also if you fulfill the contract, you will have also to incur cost. Okay, so we'll pick actually the lower between what? You will find situation. Sometimes you will find yourself, because maybe some of the environmental situations, so I'm talking about, of course, the external factors that change it, etc., that will make actually this contract, yani, executing this contract will be really much costly or higher costly than just exiting the contract. Okay, donc as a firm, you should be able to measure what, or to take as a provision the lower of what, between what will be costing you if you fulfill the contract, your part, of course, of obligation, what will be the cost that you will be incurred if you decide to exit the contract, and then, of course, you'll have to pay any penalties or compensation, of course, from that contract. We have here example, okay? So Smart Sport operates profitably in a factor that it has leased and on which it pays monthly rentals. Smart decided to relocate its operation to another facility. However, the lease on the old facility continues for the next 3 years. Unfortunately, Smart cannot cancel the lease, nor will it be able to sublease the factory to another party. The expected cost to satisfy this onerous contract are 200,000 euro. In this case, Smart makes the following entry. So you see here, you are, for example, in this, let's say, business situation or obligation to change your location, but unfortunately you already leased an old facility, and this lease actually contract is pending. You cannot really cut or exit. So the old lease here should continue for 3 years, and you expected, of course, the cost to satisfy this onerous contract will be the 200,000. So here you should record it as a liability. So here you should debit the loss on this contract for this 200, and of course this contract liability here 200,000. So here you accrued for this provision regarding this onerous contract provision. So whenever you are, of course, in that situation, you are in a situation that the cost of fulfilling the contract, they are really costly, and they are really important, expensive. At the same time, exiting the contract will be also costly, but of course you should record a liability, of course, with a lower between both here amounts. Okay. So here, assuming that the same facts as above for the Smart example and the expected cost to fulfill the contract are 200, however, the Smart can cancel the lease by paying a penalty of 175. So this is what I just discussed here. So if you are in a situation, you have the cost to fulfill the contract, so continue, of course, subleasing here the facilities for 200,000 here for the 3 years, or you have also the possibility to exit, to cancel the lease, but you have to pay penalty of 175. So at this level, what will be the amount of onerous contracts liability will be the 175, not 200. Okay, should be just picking the lower. So we should debit the same account, loss on this contract and lease contract liability here, 175. Okay. The last year type of provision, the restructuring provisions. Okay. What is restructuring, please? That's important. It is a program that is planned and controlled by management and materially changes either what? The scope of a business undertaken by a company or the manner in which that business is conducted. So please, when we talk about restructuring, meaning that's a major change in the scope maybe of the business, or also in the way the business is conducted or done. So here we're talking about substantial changes, okay? Here, when we talk about restructuring and provisions regarding restructuring, they are really not easily, let's say, permitted under IFRS, okay? Because companies that are required to have what? A detailed formal plan for that restructuring and to have raised a valid expectation to those affected by implementation or announcement of the plans, okay? So we see here what are actually the IFRS guidance related to this certain costs and losses that should be excluded from the restructuring provision. So meaning what? You are allowed to recognize a restructuring provision, meaning to accrue the liability for your plan to restructure for your substantial changes and improvement maybe of your business, but taking into consideration, not all costs will be part of this restructuring provision. You cannot include all the expenditures that you are making within this restructuring provision. So what you can include when, for example, you are obliged to make employee termination, so you incur employee termination costs that are directly related to that restructuring. When you have also any other contract termination costs, such as lease terminations penalties and any other types of onerous contract provisions. At the same time, you will be excluded. You cannot include within this restructuring provision what? Investment in new systems, lower utilization of facilities, cost of training or relocating staffs, cost of moving asset or operations, administration or marketing costs, allocation of corporate overhead, expected future operating costs, etc. So you see here, you just hear that we have, let's say, few items of cost or type of cost that are you are allowed to include within your restructuring provisions. Why? If you just ask, try to find the answer, simply because restructuring provisions, that's, let's say, a blurry here a provision or liability. As a firm, if I'm not really having this restriction, I can bury every, let's say, cost or disbursement made or any expenditure within that provision. And of course, that's likely, of course, to what? It's kind that will be inflating our liabilities and also inflating my expenses and so on. For that reason, of course, IFRS is really providing strict guidelines regarding what should be recorded as restructuring provision. Okay, you are allowed to record a provision regarding your future plan for this huge really change regarding the scope and the way, of course, the business is done here. But at the same time, small items should be included within this restructuring. In particular, of course, they are direct and incremental here, like employee termination, contract termination, any onerous project, etc. Okay. Here you have an example of this restructuring provision. December 12, Rhodia Group decided to close down a division making solar panels. On December 20, a detailed plan for closing down the division was finalized. Letters were sent to customers, warning them to seek an alternative source of supply, and termination notices were sent to the staff of the division. Rhodia estimated that Spobo that will have 500,000 in restructuring costs. Okay, so here should report a restructuring liability. Excuse me, if it has costs related to the restructuring. Okay, here we have this past obligating event, that is, of course, Rhodia here is the communication of the decision to the customer regarding, of course, here the closure of that, and of course employees, not only customers, regarding the closure of this division. So this is a constructive obligation. There is a valid expectation, of course, regarding there is no supply in the future, of course, of these solar panels, etc. So outflow of resources in settlement of this, of course, obligation is probable. Can be reliably estimated, said that to be $500,000. So here we should, of course, debit an expense, of course, and record 500,000 as restructuring liability. Okay, so restructuring expense and restructuring liability for 500,000. Okay, so this is just a simple example, a basic example when you have just to apply the provision rules for these restructuring liabilities. Okay, so here sometimes, okay, you can, of course, as a business, you make your self-insurance here. So here, when we talk about self-insurance, it is actually a risk assumption, and just to put it simple, there you are not allowed to make any provision for any risk assumption. So for any risk, because you know risk, it's part of doing business, so it cannot be considered as provision here. There is literal theoretical justification for the establishment of a liability based on hypothetical charge to insurance expense. Okay, so here when we talk about a risk, for example, I don't know, a risk in general, it is what? It is really random, and it's more than uncertain, okay? And that's why, of course, this self-insurance shall not be considered as provision, okay? There is no possibility to accrue that for provisions, okay? So please, to close this provision section, I know it's really detailed and length here, but just need to finish that. So a company must provide a reconciliation of its beginning to ending balance of each major class of provisions, identifying what caused the change during the period. So that's really important. As I said, if let's say accounting standards leave the door open to any, let's say, discretion for, of course, managers on prepare a financial statement regarding, of course, the use of liability of this provision liabilities, of course, that will, let's say, open the door, as I said, to really manipulation of earnings and, of course, misstatement and income, of course, tax dodging, etc. Okay, for that reason, we have really strict guidelines regarding these provisions. So in addition to this condition that should be met to be able to recognize a provision, in addition, of course, to the accounting treatment that should be, of course, done for any type of these provisions, but at the same time, at the end of every accounting period, because, you know, provisions can be increased or decreased depending on the situations, depending, of course, on new factors and new information, etc. We can have a reversal and we can decrease the provision, or also we can increase it. But in either situations, we should what? We should prepare the reconciliation between beginning and ending balances of each major class of provisions. Why? Here to just tell what caused that change. Why? You have, for example, recorded a litigation cost for $500,000, then you increase that to $700,000. So you are not free actually to play with these provisions and increase or decrease expenses and liabilities as it pleases you. Okay, you should provide really details regarding, of course, motivations regarding why you made that changes during that period. Okay, and also you should provide really full description of these provisions and also any expected timing or outflow that should be disclosed. Here, disclosure about uncertainties related to expected outflows. So here, when we're talking about expected here amount and expected reimbursement should be also provided. Even though, of course, we are just making these journal entries, but in addition to that journal entries, we should also provide additional disclosure in the notes regarding any description of expected timing, expected outflows, and any, of course, reimbursement that should be provided, etc. Okay. Okay. So we'll just go through the contingencies quickly. Okay. So what we qualify as contingent liabilities, and we have also contingent assets. Okay. So simply put, when we have to talk about contingent liabilities, they are what? They are not recognized in the financial statement. So here we are not talking about recognition, of course, of these items. They are not recognized. They are not part of financial statements. So when we have contingent liabilities, why? Because here, what is, after all, contingent liability? So it is a possible obligation, so not yet confirmed. So we don't talk about a present or actual or confirmed or legal or constructive obligation. It is contingent. It is not yet confirmed. Okay. Or also it can be a possible obligation or also a present obligation, but it is not probable that the payment will be made. Or there is no reliable estimate of that obligation. So here, there is no probability of any outflow of resources, or I cannot reliably estimate, of course, here the outflow, of course, or the settlement for that obligation. So please keep in mind that when we talk about contingent liabilities, they are to be excluded from financial statement. Why? Because either they are possible obligation, they are not yet confirmed, or even if they are confirmed obligation, but there is no probability that there will be payment made, or I cannot reliably estimate that payment. Okay, so here we have really some, let's say, rules or some general guidelines for to account and report for any contingent liabilities. Okay, so when we have a contingent liability, when the outcome is virtually certain here. Okay, so meaning what? We have this probability that is at least 90%. Okay, so probability that there will be unfavorable outcome. Remember, when we have this probability of unfavorable outcome, if it is of course present here, obligation, etc., then it should be reported as a liability and of course as a provision. And in most of cases, if we just summarize what we have already seen until now, is that when it is more likely than not, so meaning more than 50%. So from more than 50% here, it should be reported as a liability, so it is a provision. But if it is possible, not probable, so it is less than 50% here, it should be it should not be accrued as a liability. It should not be part of my financial statement, so it will be maybe just disclosure. I require it, so I should report. I should just provide a narration regarding, of course, this contingent liabilities. If it is remote, so here the probability is really highly uncertain, so not less than 5%, so there is no disclosure required. Okay, so these are just common general guidelines for accounting and reporting for this contingent liabilities. Okay, so it is no longer a contingent liability if we have this probability of more likely than not, so meaning more than 50%. If it is less than 50%, then it is a contingent. If it is possible, it should make just disclosure. If it is remote, there is nothing to do. Okay. So here, as opposed to contingent liability, we have a contingent also assets. Okay, so what is a contingent asset? If a contingent liability, it is possible obligation or a confirmed obligation, but with this uncertainty regarding, of course, the amount that cannot be reliably estimated, or of course the unfavorable outcome is not probable. Now, when we talk about contingent asset, it is a possible asset. It is a possible asset. So it is not resource. It is not an actual resource for business. It is a possible, and this actually asset, a possible asset that is arising from past event, the existence actually of this possible asset is confirmed by what? By the occurrence or non-occurrence of a certain future event, not wholly within the control of the company. So I cannot really have it as an asset if only some of maybe a certain future event that I don't have control over them may occur or not. Okay. So that's what we qualify as contingent asset. So meaning that an asset that its existence is contingent to other, let's say, factors that are out of the control of the company. Okay, so here when we talk about possible receipts of monies from gift, donation, bonuses, possible refunds from the government in tax disputes, pending court cases with a probable favorable outcome, etc. So they are contingent asset, and they are what? They should not be recognized on the statement of financial position. You cannot find a contingent, or you are prohibited, of course, as an accountant, to include any contingent asset in your asset section. Why? Because of this really uncertainties regarding the economic benefits that will be inflowing to the business. So an asset, a possible asset, it is a contingent and should not be recognized as an asset. Okay, so we just consider the same rules as we did for contingent liability. So if the probability of favorable outcome, meaning so the inflow of economic benefit, it is of course more than 90% here, so it is no longer a contingent, it is an asset, so it is certain. If it is probable, more likely than not, so it is contingent here, it should just disclose information, disclose it. We have additional, for example, information notes disclosures. If it is possible, not yet not probable or even remote, there is no disclosure required. Okay. So contingent assets are disclosed when an inflow of economic benefit is considered more likely than not. This is what I'm saying here. We are not. We just need to provide additional information regarding this contingent asset only when there is a probability of greater, of course, than 50%, more likely than not, that there will be inflow of economic benefits for businesses. Okay. And here we go with the last year section in this chapter. I know Krahtuni, but that's how we should. We are obliged actually to follow this rhythm to finish, please, that chapter. That's a really important part in our curriculum in general and syllabus of intermediate accounting. Okay, so. As we already learned, current liability, there are really important section, of course, within the liability and within the statement of financial position, okay? So the presentation is also important. How to report the current liability. So usually, of course, they are reported at their full maturity value. What do you mean by the full maturity value? Meaning their face value. So meaning when we have to deal with current liability, most of the situation, we don't take into consideration the time value of money, okay? Because here we're talking about the short time period, so there is no needs to make this conversion, this discounted present value, etc., that we are measuring, okay? This is what I'm saying here. So the present value and the maturity here, the difference between both here values is considered to be immaterial. That's why, of course, they are reported at their full maturity value, okay? Here we have an example of this current liability section. So we have trade payable, other financial payable, other non-financial liabilities here, derivative financial instrument, loans and borrowing, taxes payable. So this is just a snapshot of the Wilmar International Limited. You have here current liabilities section with this comparative financial statement in 2014, 2015. You'll see here the trend within the current liability, but also within the current asset, okay? So this current, of course, liability section, that's also important here in making some of the financial statement analysis, okay? So we can use actually the current liability here to what? To measure, and of course the current asset, to measure what? The liquidity of businesses, okay? So here when we're talking about liquidity regarding the liability, that's what? That's the expected time to elapse before its payment, okay? So here, how to assess the liquidity, of course, of one business, okay? We can use the current ratio or asset test ratio, okay? So the current ratio, that's the most simple here ratio when we have to what? To divide the current asset over the current liability. So here we just, let's say, measuring to what extent my current assets are able to cover my current liabilities, okay? So if we just focus on the Wilmar International here limited example, for 2015, I guess here, we have a current ratio here of 1.28 times. So here, for these businesses, we have what? Current asset that are what? Let's say, able to cover current liabilities for one time, and let's say 0.28, of course, or let's say one, if you just convert it into percentage, it will be, let's say, almost 130%, of course, of its current liabilities, okay? Maybe some others, of course, ratio that they are, let's say, more sharp in measuring the liquidity is when we exclude actually what? We exclude the inventories from the current ratio. So this is what we call the asset test ratio. So it will be just measuring the ability of really quickly a convertible current asset, of course, into cash or cash equivalent, if we am I allowed to. So here are the cash equivalent item within the current asset over the current liabilities. So we got, of course, our asset test ratio. So this is, of course, to give an information about the ability, of course, of the firm to meet its current or short-term obligations, if, of course, they have enough liquidity to pay, of course, the short-term liabilities, okay? I know that you have, of course, the FSA course that you will dig further into all of this construct. That's why, of course, I would just discuss them briefly. Do you have questions before we leave? And wish you good vacation, good revision, good preparation for the finals. and all the best.
Chapters, Professor, included in the final? Well,
Any question, please?
Which chapters? Which chapters, madam?
Okay, so yes, so which chapters? What we included in the midterm, it was chapter 1, 2, 8, and 9. So chapter 10, 11, of course, when we talk about chapter 10 and 11, but take into consideration the only parts that we covered for chapter 11. So 10, 11, 12, and 13. Okay, so fixed assets, and of course 11, it was about, of course, the impairment and revaluation, etc. And chapter 12, it was about the intangibles, and chapter 13, it was about the current liabilities. Okay, of course, for those parts that we didn't cover, like as I said, for for mineral resources that we didn't cover in the fixed asset chapter, or even here when we didn't cover some of the here parts of this chapter, like employee here related liabilities or consideration here payable, you will omit this just small parts in your revision. Okay, so only what we covered in class and online, what we already discussed, they are included. Okay, chapter 10, 11, 12, and 13. Okay. Any
okay,
question? Yes.
Madam, timing of the exam, it's the same problem. The same problem as last time when we talked about the fact that it's half an hour between it and the corporate finance exam.
wait, هو نفس السكيدول عملوها؟
نفس schedule, but they added one day, Monday the 17th. Well, they didn't add any exams for us, but they added the day as an exam day. We talked with the representatives. They told us the administration will only agree on a change unless the professor and the students agree on it.
خلينا نرجع إلى السكيدول اللي عندي. Just 1 minute. Just see clear regarding.
Madam, what about the format of the exam? Is it going to be
yes.
MCQ and
yes,
just like last time?
Just like last time. Maybe what will be different. Maybe I won't include conceptual question, or maybe I will do. I don't know. I didn't decide yet, but expect that you'll have the MCQ questions like what you got in the midterm. Okay. به احنا الاكزام تاعنا it is on Wednesday هكذا.
Yes.
Okay. دونك انتم مش عندكم نورمالمون من 11:30 من 9:30 نتاعنا الانترميديت، وبعد عندكم من ساعتين ل4 corporate finance.
Yes.
دونك احنا المشكله فيش، يعني تحبوا اكثر وقت باش تحضروا، ما عادش فما تحضير في النهار هذاك، يظل النهار ال4 تجوا حاضرين للانترميديت وللكوربريت فاينانس.
مادام احنا نحبوا كان نجموا معناها نحطوه في نهار اخر، يعني اما الكوربريت نحطوه في نهار اخر يا اما الانترميديت في نهار اخر.
اي كيسكو فو بروبوزي نهار اخر باغ اكزومبل؟ ما تعرفش خاطر راهو ملي لي سكيدول نتاع الاداره باكي حكيتو السي العسه راهو سي با فاسيل. راهو نورمالمون راكم شفتوها حتى قبل الفاكونس، حكيتو مع مدام ساميه، شفتوا مع البريزنتيف نتاعكم، شفتوا الحكايه. خاطر احنا هنا اونيتمون يعني سي الاداره كي شوازي لي دات اي تو. Donc they are taking into consideration, of course, the allocation, as I said, of all the classes. يعني ما تعرفوا levels, classes, البروف يعني bien sûr اللي باش يعسوا etc. donc يعني انت باش تقولي تنحي لي الانترميديت من مثلا هالاربعه وبعد باش تحطها ابري تو. donc ça c'est pas une question. ouais باهي. انا بدي جلي during the holidays يعني are the same situation, and it's not a problem when we got it, but دونك الايامات اللي تعدوا فيهم ديجا حتى لوين وينزداي 12 ثيرزداي فرايداي انتم حتى الساترداي يعني الايام الكل تعدوا فيها يعني ادفانسد مانجيريال برودكشن اوبريشن بي ار والبروبلم كافيك الميجور ماينور يعني اللي عندكم ماينور والميجور ان اكاونتنج اوسي يعني بيجيبوكم في فرد وقت راهو وقت اللي تكونوا وانتم موجودين فيه راه that's really the problem of بالحق يعني TBS اللي time table يعني schedule بتاع الكورسات ولا القرايه ولا حتى بتاع الاكزام it's not really easy to settle to program على خاطر هالميجور والماينور وعلى خاطر لاجو وعلى خاطر برشا حاجات. انا بون قول شنو البروبوزيسيون تاعكم؟ خل بتاتر نكلمش مدام سامي نشوفوا معاه سي بوسيبل.
باهي مادام هما نهار التالي هبطوا لنا سكيدجول جديد زادوا فيه Monday the 17th of January as an exam day. معناها نهار الاثنين لو 17 باش زادوه ديجا معناها exam day وما حطوا لنا نحن فيه حتى شيء معناها زادوا العباد اخرين معناها زادوا الفريش. نجموش نعديو في النهار هذاك معناها بما انه ما عندنا شيء فيه.
ما نوعد بشيء. انا نكلمها مدام سامية غدوه داكوغ ونشوف معها ونكلمها هي ولا نكلم سي بشير ونشوفوا نقول لكم نرجع نقول لكم شنو اللي قالت هي مي توا بور لو واحد في مخكم اللي انتم تعدوه نهار الاربعاء more likely than not it will be نهار الاربعاء but I will check if there is any possibility. Okay
thank you madame.
merci.
aucun problème. Ok je vous informe donc de شنو اللي صار وشنو اللي وصلنا. اوكي voilà. Ok Mela, au revoir, merci.
Thank you madame.
Thank you madame.
Bye bye.